You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, and in today's episode, we're going to be talking about cutoff grade. When it comes to exploration that progresses into development and you have to define a resource or a reserve, or you're getting into engineering studies as you progress down the development stage, you have to discuss cutoff grade because this really affects the economics. And here to talk us through this is Dr. Rob Stevens. He's the author of Mineral Exploration and Mining Essentials. Dr. Rob, thanks for coming back on the show, and please take it away.
Yeah, perfect, Bill. Thanks for the introduction, and my pleasure to be here today and chat with your listeners and viewers around cutoff grade, a really important parameter, as you said, for resource and reserve estimates and as you work your way into an operating mine. So let's just get right into it. What are we going to talk about today? So what is cutoff grade? Let's just sort of understand what we're talking about in terms of that term. Looking at cutoff grade applied to mineral resources and mineral reserves. So how is that applied to coming up with a grade and tonnage estimate for your deposit? Also a little bit about cutoff graded operating mines. There's some different considerations there. And then finally, just a few ending considerations or comments for your listeners to keep in mind when they're looking at material that involves a cutoff grade. All right, so what is a cutoff grade? So just starting with that first comment, cutoff grade is the grade at which the cost of mining and processing the ore is equal to the expected revenue from the ore. So essentially, it's the break-even grade. The concept is that any of your ore or any of the rock that is above that grade would be economic to mine, and so it would go and get processed and the metal would be produced. Any ore below that grade would cost you more to process it and recover the metal than the dollars you would get from it. So it would essentially be waste material. So as the second bullet there, it separates ore from waste, and it defines the mineable boundaries of a deposit, but not necessarily the geological boundaries. And I want to just distinguish with that because there are a number of different types of mineral deposits, and maybe I'll use the example of a porphyry copper style deposit, where there isn't a distinct geological boundary between what is mineralized and what is not. It's a gradation. You may go from, material of 0.5% copper down to 0.1% copper over a period, over a distance of a few hundred meters. The cutoff grade then doesn't define clearly, the geology. It defines what's mineable. So a little bit different than the geology. Now, that's not the case in all deposits. If you have, for example, an underground vein-style deposit, it often has very sharp boundaries between what is ore or mineralized and the wall rock or the waste rock. So in that case, the cutoff grade may match geological boundaries, but it doesn't always. So it's a key parameter, as we've mentioned already, in mineral resource and reserve estimates and for operating mines. And how is cutoff grade expressed? So it's often expressed as something like 0.5 grams per ton gold. So it's expressed as a grade of the commodity in this case, 0.5 grams per ton gold, or as a dollar value, generally using the term net smelter return. So for example, the cutoff would be an NSR of 1150 per ton. It is the same thing. How do you arrive at 1150 per ton is essentially what is the grade of rock that would produce a value of $11.50 a ton. And that value is also determined as the cutoff dollar value to produce that ton of rock. So it's the same thing. It's just converting the grade into a dollar value. And NSR or grade equivalent are commonly used for polymetallic deposits. So if you have a gold-only deposit, it's easy to use a 0.5 gram per ton gold cutoff. But what about if you have copper, lead, zinc, gold, and silver? It's hard to create, you can't have 5 metal cutoffs. That'd be very challenging. So you create an equivalent cutoff. So you might have a gold equivalent or you can use NSR, which basically combines all of those metals together. So we'll just look at a couple of quick examples here, and I'm going to use two deposits actually in British Columbia that I'm familiar with as examples: the Caribou Gold deposit and the Blackwater deposit. I'm going to come back to this in a sec. I want to just flip forward so people have a bit of a sense of these two deposits. So the Caribou Gold deposit in central British Columbia, and it's currently going through the later stages of environmental assessment and is owned by Osisko Development. Just a couple of diagrams here. The bottom one on the left side shows some drilling into an underground vein. So this is an underground deposit, vein-style gold. And on the right, and you don't have to sift through this in too much detail, but there's a series of deposits along a trend in this particular project. So they have identified a number of different deposits, consists of a series of veins, and have done their resource and reserve estimates and mine planning around those individual deposits. So we're going to talk about this one. We're also going to talk about the Blackwater Gold deposit, also in central British Columbia, that is owned by Artemis Gold and is currently under development. On the left here, you can see their conceptual pit design shown as the gray outline there. Within the pit is then their mineral reserves, and below the pit are their mineral resources. So this is quite a large deposit. I put a cross section here on the right side of this slide just to show you the scale. And we're talking about a 2-kilometer long pit. So, this is a big tonnage, low-grade style deposit in comparison to the Caribou Gold, which tends to be a smaller tonnage but higher grade underground vein style deposits. So these are both gold, but two different kind of end member styles of mineralization. So if I come back to this chart here, many of your listeners, of course, will be familiar with these kinds of charts. These are typical tables that are provided for resource and reserve estimates. So just to get started on looking at some of these tables, so for the Caribou Gold deposit, we're looking at the resource estimate here. And you can see at the bottom, we've got a cutoff grade of 2.1 grams per ton gold. So in this case, they've determined that any rock with less than 2.1 grams per ton gold is below cutoff and would therefore be waste, and above that would be ore. And we'll just look at the total measured and indicated in the resource. So we're looking at about 21 million tons at about 4.6 grams per ton gold. And that gives a total of around 3.2 million ounces of gold. Now, one thing I just want to mention here, and this is going to be my final point, so I'm going to bring it up now. You can see the cutoff is 2.1 grams. And in the measured and indicated, the average grade is 4.6. So this is over twice what the cutoff is. And I think that's an important feature. If you want to try to get a bit of an understanding of how good this deposit is, a good rule of thumb is to say that the average grade should be at least twice the cutoff. Because remember, cutoff is only the operating cost. It is the grade at which production equals the value you're getting from the rock. It doesn't include capital cost and other features like that, profitability. So you definitely have to have an average grade in the deposit that is quite significantly higher than the cutoff in order to cover all those other costs and, of course, be reasonably profitable. In the bottom chart here, so this is the Blackwater deposit. This is reserves now. And you can see in this case, instead of the grade, they've used an NSR cutoff. So in this case, it's an NSR cutoff of $13 per ton. Basically saying that's what it is going to cost to extract the gold out of a ton of rock, $13. And then if we look at the total reserve, what we're looking at is 334 million tons at 0.78 grams per ton gold equivalent. So what the gold equivalent in this case means is that there is some gold and some silver in the deposit, And essentially mathematically, and there's various formulas that have to be used, and you have to account for recovery, differential recovery of the metals. But essentially, you're taking your gold grade and then you're adding what would be the equivalent in gold if the silver was gold. But hopefully it didn't make that too confusing. But you're combining all your metals and just averaging them out to a single or equating them to a single commodity, in this case, gold. Now, one of the things that I guess I just, I don't like as much about the NSR cutoff is it doesn't make it so easy for me to compare the cutoff with the grade of the deposit, because the cutoff is a $13 per ton, but the grade of the deposit is 0.78 grams per ton. So I'm not sure, how those two variables relate. They're not as directly related as here, where we had 2.1 grams per ton, and then we had a grade of 4.6. So, that's a little bit of a downside for investors to do that quick comparison, because they're different parameters. One's $1 per ton and the other's a gram per ton. All right, so why is cutoff grade so important? Well, essentially the cutoff grade is going to set the size of the deposit, the average grade of the deposit, because only that rock above the cutoff will be included in the resource estimate. So that'll constrain the size and the grade. It controls the amount of contained metal in the deposit. And then from those parameters, essentially your resource estimate, all other parts of a mine are going to be established. So production rates, process plant design, profitability, life of mine, etc. So it really is a key parameter in establishing not only your resources and reserves, but much of your mine plan. So what factors are generally then considered? How do we determine what the break-even cost of producing that metal is? So the first thing I would say here is metal prices and exchange rate. So obviously metal prices are key. First, you need to know what are you going to get paid for the products that you're producing in order to understand that break-even cost. So you always have to include metal prices. Now, the exchange rate is also a critical one. If you're operating a mine outside of the U.S. or outside of a jurisdiction that uses the U.S. dollar, and that's because metals are priced in U.S. dollars. Yet if you take Canada as an example, we operate in Canadian dollars. So our costs are in Canadian, yet are selling our metal in U.S. dollars. So we have to include that exchange rate. And generally, if your dollar or your currency is less than the U.S. dollar, it works in your favor, because you basically get paid more in the local currency. But exchange rate has a big influence on the economics of a deposit. So you have to include that in there. And then mining and processing. So those are obviously the two key cost factors. What does it cost to extract the rock out of the ground? And then what does it cost to process that rock and recover the metal from it? And these three factors, metal prices, exchange rate on the revenue side, mining and processing on the cost side, are definitely included in your mineral resource estimate. Then there's a whole range of other factors here that are real costs. These are costs to produce a ton of metal, but are often not included certainly at the resource level, because you just don't have a constraint on them. But they are included when considering your cutoff grade for mineral reserves or for operating mines. So things like general and administration costs, recovery. It could be mine recovery. You may not be able to recover all your ore, say in an underground mine, or mill recovery. You're not going to get 100% of the metal out of the mine. Dilution in your mining as well. You may get some unmineralized rock that gets caught up in your ore as part of your mining method. So you have to factor in dilution. Sustaining capital for a mid or longer life mine, you have to replace equipment and that sort of thing. Those are costs. Reclamation and closure, those are costs to the mine. And royalties, refining, and transportation. So these are all costs to produce a metal of rock or a ton of rock. and the metal that comes out of it. And so all of those need to be sort of factored into your cutoff grade. But they aren't always at that resource level. And just then, it's also important to consider what are the factors that are not generally considered. So I think the most important here is your capital cost. Cutoff grade is about the operating costs, not the capital costs. So you can see if your mine was only producing or at cutoff grade, there's no profit, for one, because you're only just covering your costs. And how are you going to pay back your capital? So that's why I come with that statement of needing a grade that is considerably higher than cutoff, because you're going to have to pay back your capital. You're going to need a profit margin, of course. And then there may be other factors like exploration, corporate general and administration that also need to be, that are also have to be covered off, but aren't generally considered in your calculation. So it's important to reflect on that as well. Okay, so let's look at cutoff grade then in mineral resource estimates. So just with mineral resource estimate, I want to start with a key sort of a constraint or criteria I should put around for mineral resource estimates is that there are reasonable prospects of eventual economic extraction. So when it comes to setting the cutoff grade, you have to meet that statement. Your cutoff grade needs to be set at a level where it's reasonable that you could mine your ore and extract the metal at that cutoff grade. Beyond that, you often, you don't have all the details of, the mining method and the processing and recovery and all of those kinds of things. So you just don't have a lot of constraints at the resource level. And so, as I said, you should include mining and processing costs at a minimum. But my understanding is even that's not standardized, and in some cases, only processing costs are included. So that's just something to keep your eye on if you're looking at a resource table, and cutoff is described as to understand, what is included in calculating that cutoff grade. And then how do we know what the cutoff grade is when we don't have all the detailed mine design? Well, generally that's done with comparable projects. So you would look at similar projects in the same jurisdiction, if possible, or in other jurisdictions, look at mines, what are their cutoffs, and apply that to your project. So you can use comparables at that level. All right, let's just look at a resource estimate here. Another example. So this is from the Blackwater deposit again. Big tonnage, lower grade gold deposit. And what we're looking at here is just the measured and indicated resources. And what they've said is that their base case cutoff is 0.2 gold equivalent grams per ton, which is actually equal to a $9 per ton processed cost. So that would be their NSR cutoff. It would be $9. So you can actually see both of them here. And then what they've done is they've provided a chart that gives a range of cutoffs, starting with 0.2, which is their base case, and working all the way up to 0.7. And essentially, I like this because what it does is it's referred to as a sensitivity sort of analysis. Essentially, what happens to the deposit as you change cutoff. Now, remember, this is a resource estimate. Most of the time, your cutoff is likely to go up when you get to the reserve estimate, because now you're including more factors into the cost of operating, and so your cutoff grade will have to go up a little bit. And so right here, you could see, well, let's say the cutoff had to go to 0.3. What does that do? And I'll just go look at the gold equivalent grade. Well, it takes it to 0.79 from 0.65. And then if we look at the total gold equivalent ounces, it takes it from basically 12 million ounces down to 11.1 million ounces. So you will see as your cutoff grade goes up, essentially what you find is the gold grade goes up because you're essentially removing some of the lower grade material as your cutoff goes up, but the total contained ounces go down because you are cutting off some material, lower grade material, which means you're producing less ounces. And if I just look at my rule of thumb again, if we take the 0.2, which is their base case, that's their cutoff, their gold equivalent grade is 0.65. So they're actually more than 3 times the average grade of the deposit is 3 times cutoff. So, that gives pretty good confidence in terms of their costs being covered and payback for capital and profitability and that sort of stuff. So, down here at the bottom, quite a bit of information. And if you go to Artemis Gold website, you can find the same information there. And it provides you with some details essentially on how they've calculated the cutoff. So it gives you the metal prices that they've used, only 1,400 ounce gold, which is quite a bit below what it is right now, currency exchange for the Canadian US dollar. And then they've included things like how much they're going to get paid for their gold and silver. They have offsite costs such as refining, transportation, and insurance. There's a royalty on the mine. And they've also included metallurgical recovery. So there are a number of factors that they've included in the cutoff grade here, not just what it costs to take the rock out of the ground. So that's good. They've already added many parameters to this to the cutoff grades in this resource estimate. Okay, so in reserve estimates, if you look at the requirements around a reserve estimate, essentially reserve is what's referred to as the economically mineable part of a mineral resource, as defined in at least a pre-feasibility study. And how do we get to the economically mineable part? It's by including what is referred to as the modifying factors, which is essentially your mining costs, your recovery costs, dilution, treatment charges, environmental factors like reclamation, exploration, permitting, all those things that really do cost when it comes into a mine. And so it's not just taking the rock out of the ground and processing it. There's many other factors that have to be used here. For reserves, then, you're not using comparable data. You're using data specific to the deposit. That's determined at least the pre-feasibility stage or the feasibility stage. And here's another key point, the last one here. There may include variable cutoff grades to account for differences in mining, processing, and treatment charges for different parts of the deposit. Generally, when we look at a resource estimate, for sure, there's only one cutoff. But you can imagine, just think of a really large open pit. It's going to cost you more to get that rock out of the very bottom of the pit than it is from the very top of the pit. And so realistically, there should probably be a higher cutoff for the rock at the bottom of the pit because your costs have gone up. And so when you get to a reserve that may be applied, and it is certainly applied at operating mines, there's more than one cutoff to account for different costs of mining for different parts of the deposit. And we'll look at that again in a moment. So as another example here, this is back to Blackwater. So here's their reserve. And so in this case, they've used an NSR cutoff of $13 per ton. Now remember, in the resource, it was $9 per ton. So they've upped this now to $13 per ton because this is the mining and processing. But now they've also included general administration and some stockpile rehandling costs, which are real costs of operating the mine. So their cutoff at the reserve level has now gone up. And if you want to equate that $13 per ton to a grade, $9 was equivalent to 0.2 grams per ton. So $13 is something closer to 0.3 grams per ton. So their cutoff is now upped a little bit. And if we look at the total reserve and the gold equivalent grade here, gold equivalent grade is at 0.78, which is pretty close to the 0.3 gram per ton cutoff. So again, they had to include additional items in the reserve estimate that are realistic for the mining, for mining the deposit, and as a result, the cutoff went up a little bit. I wanted to include the reserves for the Caribou Gold Deposit as well, because this is an example of where you can see they've used variable cutoffs. So they have variable cutoff from 1.7 grams per ton to 4 grams per ton of gold. Now, why variable? If you remember when we looked at it, and actually I'm just going to come back to that, there were several small deposits in the overall project, and they're underground, and the type of mining method that they're going to use and the processing costs associated with that are different. And so using a single cutoff right across that whole project doesn't make sense. This is more realistic, where they're applying different cutoffs to reflect the costs of mining and processing and et cetera, different sort of satellite deposits within the overall project. So I like to see that, because it's more realistic to what it'll actually cost when it comes to mining. And so cutoff grades at mines, just following on that statement, variable cutoff grades are often used to address for those variable costs to produce the metal. And it may be even adjusted block by block during operation. They can start to make decisions on each block of rock that's being mined. And what are some of those factors that can cause variable mining costs? Different types of rock, different mineralogy, results in your coppers in chalcopyrite or boronite, potentially different costs to produce that. So that leads to different processing streams. If there's different types of ore in the deposit. For underground, there may be different methods that are used for different types of deposits or different parts of the deposit, and each method could have a different cost. There could be deleterious elements, that there's a penalty charged at the smelter, but only for some parts of the ore. And maybe the last one I'll say is processing capacity. So if there's excess capacity at the process plant, meaning that it's can take some more ore and move some more rock through it, you might process lower grade ore because your process plant's already operating. So putting a bit more ore into that may make sense. So that might even be a time factor. Maybe just for a period of time, you're actually going to process some lower grade ore simply because there's capacity at the mill. And, I've heard people refer to it as the pit edge cutoff grade or something like that. Once you brought that rock up out of the pit, let's say, sitting at the edge, where is it going, waste or mill? And you can make different decisions, on the fly, depending on, the specific operating conditions of the mine at that time. So just a couple of final thoughts here to wrap up this discussion on cutoff grade. So what happens if the cutoff grade is set too low or too high? If it's set too low, really what ends up happening, and just you have to think about that for a sec, by setting it too low means that you are you're assuming that your costs of mining are less than actually the reality. So in reality, you're going to have to mine higher grade material, but when you did your estimate, you used a lower cutoff. What that does is it overestimates the tonnage and the total contained metal. It underestimates the average grade that you're actually going to produce, and the mine may be over-designed because you thought you were going to move a lot of metal through there. You created a huge mill, but in reality, when your costs are all factored in, now you're having to mine higher grade material. You have less tonnage. Your mill is over-designed. And kind of the reverse then, if your cutoff is set too high. It'll underestimate the tonnage and total metal. It will overestimate the grade, and you'll expect higher grades in production than what you're actually going to produce, because now you're producing lower grade on average material. So, some of the challenges that if it's not set quite right. What happens if metal prices change? So this is a common question. Now, if the price of gold goes from $2,000 to $2,200 an ounce, does that mean you can lower the cutoff, right? Because now you're getting paid more for your same cost of mining, so you could arguably lower that cutoff, and that may well be the decision. But what about a scenario if your process plant is fixed? So there's only so much tonnage that could move through that process plant. If you now lower the cutoff grade, what it actually means is you're producing less metal, because the average grade of rock going to the process plant is now lower, yet you can't process any more. So in that way, you're better to keep the cutoff grade the same and get paid more for the same amount of metal production that you're producing. And the reaction is to reduce the cutoff grade, but I think in many cases at operating mines, that doesn't really make sense. It's better to keep it the same and as I said, get paid more for that. And then, that final point I would just say when evaluating cutoff grade, it is the break-even grade for production. It does not account for capital costs and some other factors. So a good rule of thumb is that the average deposit grade should be at least 100% higher than the cutoff grade, to be a good, robust project. So those are the kind of things to keep in mind. And I'll just end up with, thanks for mentioning my book at the beginning there, Bill. So Mineral Exploration and Mining Essentials goes through the whole life cycle of mining, including a little bit on cutoff grade. And you can get that on Amazon.com in the US and around the world, as well as .ca in Canada and .au in Australia. And also, if you're interested in courses that dig into topics like this that we've talked about today, if you go to miningcourses.thinkific.com, there's a short course, a full course, and evaluating exploration companies and news releases. So I encourage you to take a look at that as well. And with that, I'll wrap it up.